any advice that you give, and should be first and foremost in your minds when giving advice on replacement insurance. So today I'm going to give you 2 further examples of cases that we've recently investigated. And then I'm going to tell you about a few Australian examples that I've looked at to help determine what the duty to put the client's interest first means in practice. And then, of course, I've allowed some time for questions, and I really welcome your questions at the end. And I know that David's got a couple of questions for me to start the ball rolling. But first of all, a couple of recent cases. The first one I've called Getting to the Heart of the Matter. And this is a case actually that we've only just closed in the last week or so. It's a very, very recent case. And as with all our case notes, we have changed the names of the parties so that there's no chance of identifying either who the advisor was or who the complainants were. So in this particular case, the complainants, Eva and Andre, had existing life, trauma and TPD cover with insurance company A. Andre had $500,000 in life cover, $23,000 in trauma standalone cover, and $500,000 in TPD standalone cover. And then in 2012, they met with another insurance advisor, Richard, and Richard was the fiscal scheme member, about their insurance requirements. And Richard advised Eva and Andre to move their life and trauma cover to insurance company B, and also suggested replacing their TPD cover with income protection cover. The premiums were going to be slightly less with insurance company B, and Richard left Eva and Andre with insurance company's B proposal form to fill out, and obviously to answer the questions in the form about their health. Now, since first obtaining cover with insurance company A, Andre had developed a heart condition. It hadn't required surgery or anything like that. It was a reasonably minor heart condition, but it did require medication, which he took regularly, and that meant that the condition was well controlled. And in addition, Eva and Andre said they had made healthy improvements in their lifestyle since Andre had been diagnosed with a heart condition. However, they didn't disclose the heart condition on insurance company's B's application form. And of course, when insurance company B, this was after the insurance was put in place, they later discovered that Andre had a heart condition. Insurance company B at first said it would no longer insure Andre's life at all, and it endorsed the remaining cover with exclusions and increased his premiums. Eva and Andre were most upset and indignant and actually cancelled the cover with insurance company B altogether. And they then made a complaint against Richard, the advisor. Now, what Eva and Andre said to us was that they thought that a form they signed when they met with Richard meant that he would actually seek a copy of their full medical records and also information from their previous insurer, insurance company A, about what Andre had told that company about his heart condition, because certainly insurance company A were aware of the heart condition that Andre had developed. So essentially they said that they thought that Richard would fill in any gaps in the information they disclosed on insurance company's B's form with further information that he would obtain from both insurance company A and from their looking at their medical histories. Now, importantly also, Eva and Andre said that the only question Richard asked them about their current health was, "Are you currently healthy?" And they both answered yes, because they were. Now, in his defense, Richard said that the form that Eva and Andre had signed had, of course, not instructed him to seek their medical records or give him access to their records, or any other information about their health other than what they themselves had disclosed on insurance company B's proposal form. And Richard also said it was his standard practice to ask clients whether they had ever suffered from any health issues. So in other words, he doesn't simply ask, are you currently healthy? He also asked, have you suffered any health issues in the past? And Richard also said that the insurance proposal had included a declaration that both Andre and Eva had signed, saying that they understood the duty of disclosure. Eva and Andre, though, felt that Richard still hadn't done enough to advise them about their duty of disclosure, exactly what they were supposed to disclose and the detail they were supposed to disclose, and also hadn't explained the consequences of non-disclosure. So they had a real sense of disappointment. Complicating matters further, I guess, in this case, was the fact that they were, I wouldn't say they were close friends, but they were certainly acquaintances and moved in the same social circles. Overall, Eva and Andre said they felt they would have been better off if they'd never agreed to see Richard and take advice from him and had simply remained with insurance company A. Now, fortunately, they were able to secure new cover for Eva, which met their requirements, but they were still unable to match the income protection they thought that Andre had taken out with insurance company B, or insurance cover akin to the trauma and TPD cover that Andre had held with insurance company A. The complaint ended up with us, and although Eva and Andre said that they did take on some responsibility for the situation they found themselves in, they felt that they were really exposed in the event that Andre had some future issue with his heart problem. And Eva in particular was very worried because she said that if Andre, for example, had a heart attack or a serious incident like that, she would be the one left to pay their reasonably hefty mortgage and other living expenses. Now, I might say that Richard brought in his PI insurer at the very first instance, so solicitors acting for Richard's PI insurer were involved with this complaint from the very start. Now, in this particular case, after obviously discussing the various issues with the parties and with Richard's insurer, it was decided that there were some grey areas, that there were essentially, possible fault on both sides, and so this was a case that it was decided we would have a conciliation conference. We do, when there is perhaps room for compromise on both sides, and where perhaps the parties are keen to have this matter dealt with quickly by way of conciliation, which is an entirely confidential process, we often suggest this, and we often encourage parties to come to conciliation rather than having a formal decision written and imposed on one or other of the parties. So in this case, the parties were present at the conciliation, obviously, and Richard's PI solicitor was also at the conciliation conference. And we were, again, in the difficult position that even if we found there was some fault on Richard's part, it was very difficult to say what the financial loss was, because at the moment, Andre was healthy. Yes, he had a heart condition, but it was well controlled. And we were dealing with hypotheticals. Yes, it was possible at some stage in the future he might suffer a heart attack and then would no longer have the cover that he originally had. But on the other hand, he might go along merrily for the next 20 or 30 years and be perfectly healthy. As a result of the conciliation conference, essentially what Richard said he would be able to do would be to look at getting Andre some replacement life cover, and in fact that did happen. Richard was able to secure life cover, and he also was able to secure him some limited income protection cover but the trauma and TPD cover that he had under the old policy with insurance company A was not able to be replaced. To cut a long story short, we then looked at what the maximum cover Andre would have had under the old policy, and also looked at the probability, statistically speaking, of having to make a claim under that policy. And to cut a long story short, a settlement payment of $20,000 was eventually negotiated with Richard, and obviously his PI insurers were picking up the tab on that. So both sides were quite keen to get this settled. In other words, what we could have simply done was make a finding as to liability, and I think if we'd had to make a finding as to liability, we would have found fault on both sides. So we certainly wouldn't have been saying that Richard was entirely responsible. He may not even have been 50% responsible for what happened. But both sides were really keen to move on and to put this behind them, and rather than having this hanging over their heads potentially for years to come, both sides are quite keen to look at what was the sum of money that would settle this and allow both parties to walk away. I guess the lesson coming out of this complaint was that it is really important to fully explain the duty of disclosure to customers. Don't assume that a customer understands what the duty of disclosure is, and in particular, don't expect your clients to fully understand the consequences of non-disclosure. And possibly if Richard had taken a bit more care in the way he had gone about discussing the duty of disclosure, then this complaint would never have arisen. My case study 2, we've called Disclose, 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 which is coming back again to really the importance of making sure that all health conditions are fully disclosed and that the client understands the importance of doing so. In this particular case, the complainant, Shane, again had life insurance with an insurance company, and he met with a new insurance advisor to review his policies and was advised to replace his insurance with another company, so again, insurance company B. Now, Shane said he recalled asking his advisor whether he needed to disclose his pre-existing medical conditions, which were high cholesterol and high blood sugar, on the proposal form of the new company. Shane said that his advisor asked him whether he was on any medications, which he wasn't. So although he had slightly elevated cholesterol, it wasn't serious enough that he had to take any medication for it, and again, high blood sugar, it wasn't at the stage of requiring medication. And Shane said that the advisor said that if he wasn't on any medication, then he didn't need to disclose those pre-existing medical conditions. And Shane also said that the advisor told him that the new insurance company would seek information from Shane's doctor in any event. Now, unfortunately, Shane then went ahead and cancelled his existing insurance policies before actually hearing from the new insurance company that his cover would be accepted. So there was an issue there as to, had the new advisor told him, of course, that he shouldn't cancel his existing cover until being told that he had the replacement cover with the new insurer. The insurance company, actually, the new insurance company contacted Shane to tell him that it had accepted his proposal and offered him insurance. And at that stage, he then inquired with the new insurer, or he wanted to double check with them that they would cover his pre-existing medical conditions. Now, when he said that, of course, insurance company B said, well, you should have disclosed that information on your proposal. And they took the rather extreme stance at the moment, in the first instance, of saying, well, that was non-disclosure, so we're now cancelling our offer of insurance. We're not going to offer you any insurance at all. So then, of course, naturally, Shane complained immediately that his new advisor had given him the wrong advice about disclosure, and the advisor said he didn't agree with that, and Jason Shane then complained to us. And when he complained to us, he basically wanted the advisor to compensate him for the premiums he had already paid to the new insurer, which came to around $1,200. We said to Shane that it was, unfortunate that he had cancelled the new insurance policy, that he'd cancelled the old insurance policy, but perhaps he could go back to his original provider to see if they were prepared to reinstate his cover. Now, the financial advisor said that, again, he wanted to get the complaint resolved as quickly as possible, and he actually was very honest with us and said that he did recall Shane having mentioned that he had high cholesterol and high blood sugar, but that it wasn't serious enough to require medication. And he said that he really was busy at the time, hadn't really taken the matter seriously enough, and on reflection should have made sure that Shane noted them on the proposal form. However, the advisor said that, again, in his defence, Shane had given the impression that his health issues were pretty minor and that he hadn't had any problems for several years, and that he had since discovered that in actual fact Shane's pre-existing medical conditions were perhaps more serious than even Shane had let on, and in his view Shane had contributed to the situation in which he found himself. The advisor also said that he would refer Shane to another advisor to see if he could obtain or get his old insurance reinstated. The new insurance company, the advisor also contacted the new insurance company to say that it was a bit drastic of them to say that they would no longer offer him any insurance at all, and got them to reconsider, and they basically said yes, they would be prepared to offer him insurance with a slight premium loading. So in the end, the matter was settled. The advisor did pay the $1,200 odd off insurance premiums that Shane had already paid to the new insurance company. We're not sure if Shane went ahead and had the insurance reinstated or not, but this was a case that was, I guess, settled reasonably quickly and not too expensive an experience for the advisor. So now moving on to putting the client's interests first. And I suggest that in putting a client's interest first, an advisor actually has really three separate duties. Firstly, a duty to act in the client's best interests. Secondly, a duty to provide advice that is appropriate to that particular client and their needs and requirements. And thirdly, a duty to prioritize the client's interests in the event of a conflict. And I'm now going to show you how this works in practice. I'll just reinforce those. Act in the client's best interests, provide appropriate advice, prioritize the client's interests in the event of conflict. So I'm going to give you an example now. You'll see that up on your screen. So Jack comes to you wanting to review his term life insurance. He has an existing death benefit of $500,000, but decides that he now needs $600,000. And your recommendation is to take out a brand new policy for $600,000 with terms that are otherwise very similar to his existing policy. And in doing so, of course, you're going to receive a commission on the new $600,000 policy rather than simply commission on a $100,000 increase to the existing policy. So when you're doing this, obviously you're going to need to justify the fact that you have recommended that he take out a brand new policy rather than simply increasing the cover on the existing policy. So I think in this situation, the questions that you need to be asking yourself is, first of all, did I get to know the client? Did I clearly define the advice task I was asked to do? Did I make sure I gathered all the information I needed to properly carry out that advice task? Did the advice address the goals and objectives of the client? And importantly, did I put the client's interests first? And there are also, I think, two more questions that you should ask yourself to ensure that your advice really does meet the requirements of placing the client's interests first. And these extra two questions are: would a reasonable advisor believe that the client is likely to be in a better position by following my advice? And secondly, if this client was my son or daughter being influenced by my advice and trusting me to act in their best interests, is this what I would recommend? I'm now going to give you another couple of case examples, which I've actually drawn from the website of the Australian regulator, the Australian Securities and Investments Commission, ASIC. And I would actually encourage you to have a look around their website. They've actually got quite a lot of very useful information because, as usual, Australia is some years ahead of us in terms of their legislation and requirements to place the client's interests first. And financial advisors have been subject to that client's best interests duty for quite some years in Australia. And these are two examples. And one of these examples has complied with the law and one hasn't. So I'm going to ask you, I'm going to get you to read through, and I'll read through with you this case study first, and then I'm going to ask you whether you think that this was good advice in putting the client's interests first. So in this situation, as you'll see, Stephen's 56, married, self-employed. He's held life, TPD and trauma insurance for some time, with a sum insured of $190,000, and has held income protection insurance since 2010. He's got an insured monthly benefit of, as you see, $11,576. Total premiums $17,513 per annum. Now, Stephen comes to you because he feels that he's paying too much in premiums. He's comfortable with the level of life, TPD and trauma cover, but he actually wants to increase his income protection cover slightly to $12,000 a month. Now, the advisor compared Stephen's current insurer with 3 other insurers before recommending that Stephen take out life insurance and TPD cover and trauma cover, and increase the income protection insurance with an insured monthly benefit of $12,500, so slightly more than Stephen said he wanted. Similar 30-day waiting period and benefit paid to 65, and the annual premiums came down quite nicely by about 15% to save him $2,600 odd a year. So in other words, the new insurer had a more competitive premium and also had some improved trauma policy definitions compared with the existing policy. So I guess my question to you is, do you think this advice has put the client's interests first? Does this appear to be good advice to you? So David, perhaps we could quickly run a poll on that.
So how we're going to work this, guys, is not. This is because it's a slightly more complex question. We won't run it as a poll specifically. What we'll do is we will get you to put your comments and questions in the questions area of your GoToWebinar control panel. So Susan, can you repeat the question again?
Yes, we're really looking at the proposal that's or the factual facts are up on the screen. Do you think the advisor has put Stephen's interests first? Would you regard this as good advice?
Okay, and is there other additional information you would need, and maybe supplemental to that, is there additional information you would need to be able to make a determination on that? So
yes,
hopefully,
yes.
yeah. So there's no questions coming up yet. So if you are familiar with the most of you, I think, are familiar with it. We'll go to Webinar Control Panel. Use the questions box, or if you prefer, you can use the chat area, whichever's easier for you. I'll be monitoring both of those. Okay, so there's a couple of questions here. Yayupa says, was the original income protection on level premium?
Yes, that I don't know from this example.
Yeah, it'll be an interesting question that would need, I think, to be answered before. If we assume that how should we assume, Susan?
Well, look, I tell you what, I'll tell you what ASIC's view on it was, perhaps, and their view that this advice was compliant with the law. So essentially, the advisor had achieved the client's stated objectives of maintaining the same insurance type and cover. They'd got him the increase in income protection cover that he wanted to reflect his current earnings, and also, of course, it met his reason for seeking advice of getting a cheaper premium. So, in other words, as I said, it was fully compliant with the law. There was a question as to what would have made this advice high quality advice as to merely compliant advice. And ASIC said that high quality advice to Stephen would have included the advisor making further inquiries about Stephen's relevant circumstances and his needs and objectives to ensure that the type and amount of cover recommended was suitable. So in other words, rather than simply taking Stephen's word for it that his current life cover was sufficient, it would have been good to have gone through perhaps a full fact find with him to check that in actual fact that sum insured, which I guess $190,000 these days isn't a lot, isn't, in terms of life insurance, was that really sufficient for his needs and requirements? Because without going through a full fact find and making further inquiries, it's very difficult to say whether he's overinsured or more likely underinsured. And also making further inquiries to assess whether he really needed the trauma cover or whether a longer waiting period or a shorter benefit payment period would have been suitable. So in other words, just exploring, I guess, all of his options.
So this looks like very much it was more of a product placement engagement rather than an advice engagement.
That's right. Yes.
Well, that's the way it was treated.
Yes, yes. And I mean, certainly, as I said, they'd obviously done what Stephen asked them to do, but so had complied with acting in his best interests, but they could have gone the extra mile and looked at all of his, done a full fact find and perhaps suggested other changes that could have been made to his cover.
Yes, particularly in light of the fact that this policy had been in place for quite some time.
Yes, that's right. That's right.
Okay.
Okay, this is case study 2. Obviously a different case. In this case, we're dealing with a 62-year-old woman who's single, earns $40,000 per annum, and June is also the guarantor on her adult son Matthew's home loan of $300,000. Matthew earns $50,000 a year, and his home is valued at $450,000, and June also owns her own home valued at $450,000. June has no debt, but Matthew has a $300,000 mortgage. Neither June nor Matthew have existing life insurance, and the reason for seeking advice was that they wanted to obtain some insurance as security against sickness and injury. Now, in this particular case, the advisor recommended that June take out $400,000 worth of life insurance cover, and as you'll see, during the application process, 75% health loading was applied, which increased her premium from, well, almost doubled it actually, from $5,829 to $10,260 per annum. And the advisor also recommended that Matthew take out $500,000 of life cover, $300,000 of TPD cover, and income protection of $3,500 a month. So, I would hope that probably this is a bit of a no-brainer for most of you. In this case, ASIC were of the view that the advice to June failed to comply with the law, so the advisor had given poor advice and failed to put June's interests first. There was no reasonable basis for this advice or any explanation on the advisor's file. So this case study came from an actual file of an advisor that ASIC had looked over. There was no explanation as to why June, who was single, with no debt or dependence on her would need $400,000 worth of life cover. If June were to die, it was reasonable to assume that Matthew would inherit her unencumbered home valued at $450,000. So the advice to June had not addressed her stated objectives of the need for insurance to address sickness and injury. And of course the premium was also really getting very unaffordable for her. Even before the 75% health loading was applied, premiums of $5,829 on a $40,000 per year income were going to be fairly onerous for June, and potentially erode very modest retirement savings that she had as she approached retirement age. So that was a case that quite clearly didn't meet standards expected. Before moving
Susan,
on,
did they take out that cover
sorry.
before raising a complaint?
I don't know. As I said, I've just drawn this from ASIC's files,
Right.
but I imagine that, I really don't know, but I would imagine probably that a complaint had been made by the very mere fact that ASIC were involved in this case.
Right.
I would now just, before allowing some time for questions, just like to remind you of the best practice guidelines that I mentioned at our last webinar, because when we investigate complaints and deal with complaints, we're always looking at lessons that can be learned from those, trying to take a positive from them, and sharing those with other advisors in the hope that the tips that we learn from complaints will help you avoid facing complaints in the future or finding yourself in a similar situation to some of the advisors that have had complaints before us. So, best practice when you're giving advice on replacement insurance is obviously to compare providers and products and give specific reasons for the proposed replacement and why the client's current policy doesn't adequately fulfill their objectives, and why why in your opinion the new product recommended does do so. You should highlight the key differences between the products, any difference in features, definitions, any difference in stand-down periods, for example. It's really, really important, and I can't, I guess, stress this enough, to make sure that you tell the client about their duty of disclosure, why this is so important, what the duty of disclosure entails, and in particular the consequences of non-disclosure. It's very, because you all work in the industry, as do we, it's very easy for us to assume that people understand the duty of disclosure, but I can tell you that they don't. And so many of the cases that come to us come about because the client just has not understood exactly what is meant by duty of disclosure and what the consequences are if they don't properly disclose. And another really common misconception, and I don't really know why this is, but there's a common misconception that a new insurer will go and seek a client's medical records as a matter of course, whereas of course, as you and I know, that doesn't often happen unless the insurer has been put on notice that they need to make further inquiries and get further medical information. Yes, so it's very important to make sure that the client understands that it's not standard form or a matter of course for a new insurer to seek their medical records. Underwriting risks, again, perhaps an explanation as to why it's so important to disclose pre-existing medical conditions is that obviously is going to affect the way that the insurer look at underwriting the policy and may obviously result in some policy exclusions, restrictions or premium loadings. Costs and commissions, very important to make sure that the client understands obviously the difference in any premiums that they will be paying with a new policy compared to an old policy, and understanding that how you're remunerated, and if you do have a clause in your terms of engagement allowing you to charge a fee if the client cancels the policy within the first 2 years, that the client knows that will have what that fee will be, or understands that there will be a fee charged. It's really important to explain how the implementation of the replacement business will take place, and making sure, of course, that the client doesn't cancel their existing cover until they know that they are going to be covered with the new insurer and the terms on which they are going to be covered, and that they're happy with those terms. And obviously also diary for a follow-up. Again, best practice is that you will follow up with your client, and I don't know, it would be interesting to know from you how many of you do this and what your follow-up period is, but when they can next expect to hear from you and undertake a review of your insurance needs. And if, for example, there is a premium loading that is perhaps going to be reviewed by the insurer, making sure that you follow up with the client and check that the insurer has carried out any reviews that they have promised to do. I'd just also like to mention that the Financial Services Council has a replacement policy advice on process sheet on their website. I guess a lot of you will probably be aware of that, and I'd be interested to know if many of you use it, because to me it seems a very good starting point to have in the back of your minds when you're giving advice on replacement insurance.
Okay, so let's actually ask that question, Susan. So, does anybody use the Financial Services Council form? This was produced, I think, 2 or 3 years ago, wasn't it, Susan? And
yeah,
there was an
attempt. Been around a while.
Yeah, there was an attempt to try and get it universally accepted, but it unfortunately didn't. That universal acceptance didn't materialise. I think there were too many people or too many companies not willing to accept it as the bog standard, or as the standard best practice. I think there was a bit of kickback on that. So whilst it's there, I think there's a lot of people that don't use it. Does anybody in the audience use that form as a matter of interest? Go and use a questions box if you've got, if you can respond to that. No, so yeah, I think the responses are typically no, and in fact there's a couple I weren't aware of it either.
Okay. Well, do have a look. Do have a look. There's quite a lot of good information that you can get from Financial Services Council website, the FMA website, but also, as I said, ASIC in Australia. I guess it's also worth reminding people that there have been a number of cases in the courts in Australia where advisors have been held liable for misleading and deceptive conduct and negligence in switching clients from one insurance policy to another. And of course, as I've already said, we're starting to see complaints to us now where people have made complaints about the quality of advice given when being advised to switch insurers. We can award compensation up to $200,000, so it's a fairly I don't want to use the word penalty because it's not a penalty, but we do have reasonably substantial powers, and I do expect to see more complaints in this area. But really, by attending webinars like this today and learning lessons from complaints that we've had, and taking on board tips to avoid those complaints, I really hope that none of you see yourselves in that position. David, you've got a couple of questions, I think, for me, which out of. Do you want to perhaps read those out now? And
yep, I'm just going to post Carol just asked what the website address is for the Financial Services Council, so I just posted that up there. Gosh, it's tons of really useful information again, Susan. Thank you for sharing that with us. And I think some of the case studies highlight some interesting challenges that we face as an industry in terms of making sure that the the advice we give is appropriate to the client's needs and is documented in a sufficient way to demonstrate that.
Yeah. Yes, actually, that's another really good point there, actually, David. I think I probably mentioned it in the previous webinar. Do keep good documentation. I can't stress it highly enough. As the professional, you will be expected to have kept notes. So, for example, if you ever had the FMA coming in and wanting to look at some of your client files, they will expect to see good documented notes, including reasons as to why you've given the particular advice that you have. I know it's a pain. I know that everybody's really busy and it's hard to make time to perhaps type up a file note, but I really encourage you to do it, particularly where you've keep notes of a meeting, any meetings that you've had with the client, or even telephone discussions, because when we get involved, often when a complaint arises in a he said, she said situation, it's invaluable for us, the dispute resolution scheme, to have contemporaneous notes on file. And if we see an advisor's file and there's no notes at all, and we know that meetings have taken place, it's not a good look for you, the advisor, as the professional, that there are no notes at all of that meeting.
Yeah, interestingly, a number of the CRMs nowadays make that process a little bit easier.
Good.
So we've got I'm working with an advisor at the moment who has when a phone call comes through to his mobile phone, it automatically and it recognises the number. It asks, "Do you want to file a note against that client record?" So it automatically prompts the advisor to actually do that, which is quite cool.
Good. Mm.
Okay, so let's go through some of the questions that have arisen as we've gone through the process. A couple of the cases I think you presented today related to less around advice and more around product placement engagements. Is there anything? I guess the issue that arose and the complaints that potentially arose was because the advice that was given was not necessarily appropriate. But are there some things that advisors perhaps should have in place if they are engaged just to look at product rather than specifically giving advice? Are there steps they can take to manage the outcome or the potential complaint outcome?
I guess just making sure it's clearly documented that you are simply advising on product placement rather than giving a full advice, giving full advice. It's a little bit like we see with the financial planning investment advice, that there is a clear difference between someone that wants a full investment plan drawn up for them or someone that just wants to come along and place their money in a particular investment because perhaps they've heard about that particular investment from a friend or colleague. So again, it's making sure that you've documented that it is product placement only and that the client understands that, because another type of complaint we see is where it has clearly been a product placement only, but somehow the client has come away from it thinking that nevertheless you're giving them advice and acting in their best interests when that wasn't the nature of the engagement. So much really comes down to, I guess, managing a client's expectations and making sure that the client is on the same page as you, I guess. A lot of complaints we see, and this isn't just in the financial advisor space, but right across the board of financial services, often come down to a breakdown in communication or poor communication where the advisor or the financial service provider just hasn't been on the same page as the client.
Right. So in that case, and we're talking about replacement products placement only, it would perhaps be appropriate to get the client to actually sign the clause to say that this is only that our engagement is purely for the purposes of placing insurance product, not any advice.
Yes, that would
That
certainly.
they sign to that
Yeah.
effect as a clause, so maybe as part of the limitations in scope, in the scope of
Yes.
service.
And I would actually
Uh,
get them to initial, rather than just signing at the bottom of the page, actually initial that clause as well.
yeah, yeah, that's good practice. Okay,
Yes.
because I think it happens a lot. You know, there's a lot of times I think where advisors are just engaged to say, oh, you know, I want you to look at my insurance. I've got some existing insurance in place. Can you do something better for me?
Yes.
And I think that's the challenge, isn't it? It's that engagement
Well,
then is purely around looking at alternatives.
yes, though, I would probably say a good advisor in that situation would still be saying to the client, getting, full information from the client and doing a full, um, have they got the right insurance in place? And is there some other type of insurance cover that would perhaps be better suited for them? I mean, at the end of the day, um, I'm assuming that you'll be earning the same amount of money you would as if you went through a full advice process. So, um,
Yeah. So good practice.
personally, I think good practice is to, as a matter of course, make sure that you're doing a full fact find and giving advice rather than product placement. Which would, of course, would also avoid complaints further down the track where the client thinks that you were actually giving them full advice when you weren't.
Yeah, yeah, that's the challenge, isn't it?
Mm.
Okay, so a couple of other things that have come up. There was one case you referred to where a client had existing life cover in place, I think of 500,000, and it was recommended that, and he was looking for 600,000,
Mm.
and the advisor recommended complete replacement as opposed
Yeah.
to an increment. Obviously,
Yes.
there's some remunerative benefit, some more higher remunerative benefit from the point of view of the advisor.
Mm.
Um, is one of there's obviously some disconnect at the moment between the disclosure requirements of an RFA and the disclosure requirements of an AFA,
Yes.
whereby AFAs have to disclose the remuneration.
Mm.
Would you counsel advisors to explicitly highlight the remunerative difference between the two alternatives?
I think, again, best practice, full transparency, yes, they should. And I think if ever an advisor, for example, had the FMA coming in and looking over their files, the FMA would probably want, first of all, an explanation as to why they had chosen to replace the insurance with a new product rather than simply increasing the cover under the existing policy. And I think, well, it will be interesting to see what comes out in the draft exposure bill, which I think is due out fairly soon, following the review of the Financial Advisors Act. But it seems clear that there is going to be more transparent, more detailed disclosure of commissions required, which I think is a bit of a quid pro quo, I guess, for government deciding that they're not going to tinker at all with rates of commission, which, as you know, in some circles it was being suggested that we should be moving perhaps closer to the Australian route, going down the Australian route. But I think the quid pro quo is that advisors are going to have to be a lot more transparent about disclosing how they're remunerated. And I think that will include saying, I'm going to earn more commission by replacing your insurance than increasing the cover under your existing policy.
Yeah,
And
and I
quite
think
frankly, in my experience, I don't think clients are going to be bothered about that. They understand that advisors have got to be paid, and they're quite happy that it's the insurance company that's essentially paying the advisor rather than the client having to write out a check. But so I don't really see that there's any detrimental effect at all to full disclosure. I think it will only increase the professionalism of the industry myself.
Yeah, I think that there's an increasing sense that actually, a number of our members are AFAs as well. Obviously got RFAs as well, and if you talk to AFAs who have had this obligation to disclose remuneration for 3 or 4 years now, the indications are that the clients don't really care as long as they're getting the right advice.
That's right, and then again, you're going to avoid having thrown back at you, which we see now sometimes with complaints. Oh, well, you simply did this because you were going to earn more commission, because the client subsequently found out that that the advisor earned a lot more commission for doing it this way than that, and obviously that immediately makes the client suspicious and gives them another ground to complain about. Whereas
Absolutely.
if everything had been fully disclosed up front at the beginning, then it wouldn't be an issue.
Yes, absolutely. And actually, Carol's making a point here. There's a difference between saying I'm going to get more commission and actually disclosing the amounts concerned. I think we're talking about we're disclosing the amounts concerned. I don't think it's a case of saying we're going to get more commission.
Yeah, I think I think. Well, I mean, again, we're going to have to wait, aren't we, until we see what comes out in the bill. But my feeling from all the talking to MB and certainly all of the various forums and so forth I've been to is that there are going to probably have to be dollar amounts involved. That it's not just saying I'm going to earn commission. The client's going to have to be told what that commission is, at least in sort of round dollar terms. I mean, the more interesting issue, I guess, is whether disclosure of soft commissions is going to be required, and if so, how that can possibly be done. But I guess that's an issue for the regulators.
Yeah, that's an entirely different ballgame, isn't it? I think from my reading of the proposed changes, it does seem that they're going to do. There's a couple of things coming out of the changes to disclosure. One is going to be some simplification of it, because I think there's reasonable evidence that the AFA disclosure requirements are too onerous, and the clients clients haven't got a clue what they're actually what's being disclosed to them. So I think there's going to be some simplification, but I think there's also going to be some standardisation as well. So all advisors will be required to disclose remuneration. Now, I'm conscious of time. I've just got one more question that I would like to just cover off briefly, and it's a topic we touched on in both webinars we run on this subject, and that's around medical records and trying to. I mean, in my own situation, I can't remember the last time I went to the doctor, and I can't remember what I went to see the doctor about. When it comes to completing medical props, it's really hard for the client to remember what they've been to the doctor for, and they often, as evidenced by one of the cases you mentioned today, they actually don't necessarily understand the severity of any treatment or any condition that has been diagnosed. Are there some...
Or it might have happened a long time ago and they think it's no longer an issue.
Yeah, exactly. Are there some things that I'm just thinking through this process? We talked about the possibility of requesting the insurer to seek the medical records.
Yes,
but
I mean, certainly...
reluctant to do that because there's a cost.
I know they're reluctant to do it, but I think, if I personally was going to be filling out a proposal today, like you, David, I couldn't possibly remember all the times I've been to the doctor in the last 5 or 10 years. Probably not even in the last year, actually, with my memory. But there is, quite a group of, I guess there is some case law out there that the safest thing to do is to actually write on the proposal form to the insurer that you have disclosed all of your medical history to the best of your ability, but that there may have been doctor's visits that have not been noted down, and that you authorise the insurance company to seek a copy of your full medical records from the doctor. Now, I know that insurance companies don't like doing it, but then at least the insurance company is on notice that there may be a few doctor's visits or minor matters that you haven't mentioned.
Yeah, so that is.
And then at claim time, then it falls back on the insurer. Well, you were put on notice that there may have been. I mean, clearly, if you hadn't disclosed something that you clearly ought to have remembered, for example, if you'd, I don't know, had a minor stroke 3 years ago that required hospital attention and you hadn't written that, it's a bit hard to forget that. I don't think saying I authorise you to look at my doctor's notes would save you in that scenario, but it may well save or mean that the insurance company are on notice and would find it difficult to decline a claim in other circumstances.
Yeah, by virtue of the fact that that has been highlighted.
Yes.
Carol's makes a point as well. These days, most GPs will send their medical notes to the client on request. Doesn't necessarily
Yes.
need the insurer to do that. So potentially that could be an option as well, is to get the client to request
Yes.
their medical
Yes.
records and then send that as an attachment potentially or as a supplement to the
Mm,
prop.
absolutely. Yep.
That might be an option which
Yes.
avoids the cost issue.
Yes.
And David Cooney makes another point that very often doctors and clients don't understand the difference between medical and insurance risk, two very different topics, which I think is a very
Yes.
valid point, David.
Yes.
Okay, it is 2 minutes to 11, so I think we'll close up here. Thank you to the audience for taking time out of your day. Sorry it was on a Thursday. I know there's a couple of people that struggled to make Thursday. But hopefully you found the subject of value. It was one that was very, very well commented on at our last, when we were in the first one, and I think we'll probably have something similar today. Susan, if people have questions, they can come back to you or they can come back to me and I'll forward the questions through to you.
Yes, happy to answer any questions.
Thank you. Today's session is eligible for one structured CPD-hour, so you will need to complete the reflection survey and follow up that you should get when we close the webinar. And you should also get a copy of that. I think it's a day or an hour after this webinar. And Susan, once again, thank you so much for a very, very informative presentation. Really insightful and some real valuable takeaways that people can go and use within their practice.
Great. Well, thanks,
Thank
David.
you.
We're all about not just investigating complaints, but as I've said, passing on lessons that can be learned from them.
Yeah, and that's probably one of the most valuable things that I think you guys provide is that education. It's really, really valuable. Our next one with Susan, I think, is on disclosure. So it's probably related to this topic, quite
Yes.
closely related. Which I think it's in November, October or November, but it'll be up on our website. Thank you, guys. Enjoy your day, and we will hopefully see you online next Friday for our compliance matters series, looking at on the web. Thanks very much.